So you're looking to really grasp the important stuff, yeah. Cut through all the noise and get right to the core insights. Well, that's exactly what we're planning to do today. We are diving deep into Warren Buffett's 2024 shareholder letter for Berkshire Hathaway.
And this really isn't just your standard corporate comms. Buffett's letter gives you this incredibly direct look into the thinking behind, well, one of the most successful investment records ever.
Right.
We're going to unpack his views on business, on investing, and that long-term thinking that really sets him apart.
Exactly. And this latest one, it touches on, well, everything from his personal reflections on Charlie Munger's huge impact to a really candid look at Berkshire's 2023 performance, key insights into their different businesses, and, yeah, of course, his core investment principles.
So our goal is to pull out the most crucial, the most genuinely interesting bits for you.
Okay, let's get into it. Starting with, well, the huge figure of Charlie Munger. His presence just echoes through the whole letter.
It really does. Buffett's tribute, it's deeply personal, but also really sheds light on their, amazing partnership. He calls Munger the architect of today's Berkshire and himself just the general contractor.
Yeah.
That really was a lot about Munger's role in, designing the whole strategic plan.
What really stood out to me was that specific moment he talks about back in 1965. Munger telling him buying Berkshire was, quote, dumb on its own, but then immediately showing him the way forward. That was a real pivot, wasn't it?
Oh, absolutely.
Moving from buying fair businesses at wonderful prices, the classic Ben Graham thing Buffett did, to getting wonderful businesses at fair prices.
Yeah, and what's kind of wild is that back then, Munger didn't even have any money in Buffett's partnership.
Right.
That advice was purely from his conviction in a better way, even though it meant moving away from those established value ideas. It says so much about Munger's independent thinking, And it wasn't just words. It was a shift from just looking at assets opportunistically to valuing real durable advantages and pricing power that totally changed the kinds of businesses they'd look at.
And Buffett admits he took that advice, though he also says he did some backsliding sometimes. It sounds like Munger's just this constant sanity check for him.
Definitely. Buffett says Munger repeatedly jerked me back to sanity when my old habits surfaced. Their whole decades-long thing, it was way more than just investing together. It was this continuous, intellectual back and forth, mutual respect. Munger always pushing him.
Like having a really sharp co-pilot.
Exactly.
It's also pretty striking how Buffett notes Munger never sought to take credit for being the architect, letting Buffett get most of the public praise. That's quite something, that humility.
It really is. Buffett calls their relationship part older brother, part loving father, which kind of shows Munger's supportive but guiding hand. Even when Munger knew he was right, he let Buffett lead and, crucially, didn't harp on Buffett's mistakes. That dynamic, it clearly played a massive role in their success. Okay, so let's shift gears a bit. The letter then talks about Berkshire's unique relationship with its shareholders.
Yes, and this is pretty different from what you usually see with public companies, right?
Yeah.
Buffett really emphasizes that their shareholders are in it for the long haul, like people buying a farm, not just trying to make a quick buck.
And because they're aligned like that, Berkshire can talk to them really directly, really honestly. Buffett says their job is basically to give the good and the bad news, straight from the CEO, not filtered through some optimistic PR lens.
He even brings in this perfect mental model for the reader. His sister, Bertie. I thought that was a brilliant way to frame it.
Oh, yeah.
Bertie's smart, sensible, reads the business news but isn't an expert, and she doesn't trust the pundits.
That Bertie idea is great. She's like the intelligent person who gets basic business stuff and uses common sense. Buffett's basically saying, look, I'm writing this for Bertie, someone who just wants the truth without fancy talk. And that leads right into this key point about how you should actually measure Berkshire's performance.
Exactly. The letter spells out why GAAP net earnings are kind of problematic for them, mainly because they include those unrealized gains or losses on their huge stock holdings. And those numbers can jump around by billions, like daily.
Yeah, it's fascinating how he critiques this required accounting rule. He basically says, look, we have to report these unrealized swings in net earnings, but they don't really show how our actual businesses are doing day to day. Because they own so much stock, their reported profit can go wild just because the market had a good or bad day, which says nothing about the railroad or the insurance companies.
Right.
Operating earnings take out those paper gains and losses, so you get a clearer view. He even makes a funny little reference to Galileo Galileo about questioning rules.
So for a more accurate picture, Berkshire focuses on operating earnings. That strips out the volatile stuff and gives a steadier look at how the actual businesses are performing.
Exactly. Operating earnings are a much more reliable guide to their ongoing profit. But Buffett's also very clear that those capital gains are still expected to be a huge part of Berkshire's value growth over the long term.
Yeah, he reminds us he's been investing in U.S. stocks pretty much his whole life, since 1942, and points to how much the Dow has grown since then.
And it loops back to Ben Graham's idea, right? The market's a voting machine short term, but a weighing machine long term.
Yeah, totally. It just reinforces their focus on long-term value, not getting distracted by the daily market noise.
It's fundamental to how they operate. Okay, so let's dig into their core business strategy.
Well, the main goal, simply put, is owning businesses with good economics that are fundamental and enduring. Sounds simple, maybe, but Buffett stresses how hard it is to actually predict which ones will last.
Precisely. He warns about people claiming they have all the answers, calling them either self-delusional or snake oil salesmen. What Berkshire really loves are those rare companies that can reinvest their capital at high rates of return for a long, long time. He makes the point that owning just one great company like that and holding on can create incredible wealth.
And it's not just the business itself. The people running it are just as crucial.
Mm.
Buffett really hammers home the importance of having capable, trustworthy managers. He even quotes that old 1863 warning from Hugh McCulloch, never deal with a rascal.
Under the expectation that you can prevent him from cheating you.
Yeah. That really shows the human side of their decisions. No matter how good a business looks, the leaders have to be solid.
Mm-hmm.
And they've had disappointments, which just shows how hard judging character really is.
Now, a huge challenge for Berkshire now, given its size, is finding deals big enough to actually move the needle. I mean, a $561 billion net worth, that's nearly 6% of the S&P 500's net worth if you exclude Berkshire itself. Doubling that quickly is just, well, mathematically tough. Exactly. Their sheer size really shrinks the pool of potential acquisitions. There just aren't that many companies in the U.S. big enough to make a real dent, and everyone else is looking at them too.
Right.
And outside the U.S., finding places to put that much capital effectively is even harder.
Plus, Buffett is crystal clear they are highly averse to issuing shares just to puff up their net worth. That limits their options for growing fast through deals even more.
Yeah, not issuing shares protects the existing shareholders from getting diluted. So given all that, Buffett gives a more realistic outlook. He expects Berkshire to do a bit better than the average American corporation with materially less risk of permanent loss of capital.
Which is, a bit more modest than maybe when Bertie first invested, acknowledging how massive they've become.
Right. But even with those size constraints, Berkshire has what Buffett calls its not-so-secret weapon, its incredible financial strength and readiness.
Ah, yes, the war chest.
This is absolutely central to their strategy. Having all that cash and the certainty that they can perform lets them jump on opportunities when markets get messy or the economy stumbles. He points back to crises like 1914, 2008.
Right, like in '08 when they could step in and help companies like Goldman Sachs or GE when nobody else could, and get good terms because they were solid.
Exactly. That financial strength becomes hugely valuable then.
And he even notes that markets today seem to have more casino-like behavior, which maybe makes being prepared even more important.
Mm-hmm. That volatility just highlights their core rule: never risk permanent loss of capital. Buffett stresses that long-term success comes from a few good calls over a lifetime, and crucially, just avoiding the really big, unfixable mistakes.
And Berkshire's ability to handle financial disasters is so big, Buffett thinks they can actually help stabilize the country in a crisis, like they did in a smaller way in '08-09.
Yeah, their strength lets them provide liquidity when others are scrambling. He talks about their Niagara of diverse earnings, after all expenses pointedly not using EBITDA as a key metric, and how they deliberately keep way more cash and T-bills than most people think is necessary as a safety buffer.
That extreme fiscal conservatism, as he calls it, is really about protecting shareholders like Bertie from getting wiped out, even if it looks maybe overly cautious when times are good.
Definitely. Okay, the letter also updates us on some of their big non-controlled investments, starting with the old favorites, Coca-Cola and American Express.
Ah, the classics. These really show that buy and hold wonderful businesses strategy, don't they? Global brands, timeless products, decades of dividend increases, even when those companies had rough patches or management issues.
Yeah, he jokes they aren't too keen on newcomers, given how long these have been around. They really embody finding those enduring brands with strong competitive advantages, the wonderful business idea.
And even though Berkshire didn't trade any shares in 2023, their ownership percentage actually went up a bit because Berkshire bought back its own stock.
Right.
The lesson again, when you find a truly wonderful business, stick with it. Patience pays. Simple but powerful.
Then there's Occidental Petroleum. They bought a lot more in 2023, up to nearly 28%, and they have warrants to potentially buy even more. Buffett highlights Oxy's huge U.S. oil and gas reserves and their work in carbon capture, though he does add a note of caution about whether the carbon capture part will really pay off economically.
He also really emphasizes how important the shale boom was for U.S. energy independence, pointing out that Oxy's annual oil production is getting close to the entire U.S. Strategic Petroleum Reserve. And he seems pretty impressed with Vicki Hollub's leadership there.
Yeah, definitely gives her praise. Finally, he talks about their increased stakes in 5 big Japanese trading companies: Itochu, Marubeni, Mitsubishi, Mitsui, Sumitomo. These are really diverse conglomerates, a bit like Berkshire in some ways.
Right, and he mentions they mostly paid for these by issuing bonds in Japanese yen. And he likes their shareholder policies buying back stock. More reasonable executive pay compared to the U.S. sometimes.
And the strategy seems to be more than just the investment return. He sees potential for future partnerships with these huge, well-run global companies. But building up those big stakes takes time and patience, especially for someone as big as Berkshire.
Okay, so shifting to Berkshire's own 2023 performance. Operating earnings hit $37.4 billion, which is a nice jump from $30.9 billion the year before. It's interesting to compare that to what they sort of expected at the 2023 annual meeting.
Yeah, Buffett had thought earnings might be lower in most of the non-insurance businesses, with maybe BNSF and BHE providing a cushion. He did expect investment income to rise with higher T-bill rates, and he thought insurance would do well.
So how did it play out?
Well, insurance did even better than expected, which was great. But BNSF, the railroad, and Berkshire Hathaway Energy, or BHE, were actually disappointments.
Okay, let's start with BNSF. Huge railroad, vital to the economy, biggest in North America. But earnings fell more than they thought.
Yeah, partly falling revenues, but also wage increases were higher than inflation. And Buffett also points out that the money they have to spend on maintaining the railroad, the capital expenditures, is actually more than their depreciation charge. That limits the cash BNSF can send back to Berkshire as dividends.
So it's super capital intensive.
Extremely. Buffett says while they're getting an okay return on what they originally paid, it's tiny compared to what it would cost to replace everything today. He also touches on the tough working conditions and, sadly, the issue of suicides on the tracks.
Wow. Okay, and the other disappointment was BAG, the energy unit.
Right. Most of its businesses did okay, but they ran into regulatory problems in a few states. That raised big questions about future profits, even mentioning bankruptcy risk in some cases, like what happened with PG&E or Hawaiian Electric.
So the old model of utilities getting a fixed return isn't working everywhere.
It seems to be breaking down in some places. And the huge costs from more frequent and severe wildfires, linked partly to climate change, are also hitting BHE hard. Buffett even flags the possibility that other utilities could face similar survival issues, maybe leading to more public power setups. He admits they didn't foresee how bad these regulatory issues would get, and that it was a costly mistake.
Yikes. Okay, but on the bright side, the core insurance business had a fantastic year.
Absolutely stellar. Record sales, record float, record underwriting profits. Buffett highlights the 57-year history there and how much it's grown. You know, the premiums they hold before paying claims is key.
Right, they get to invest that money.
Exactly. And if they underwrite well, it's like free or low-cost leverage. The key, he says, is just disciplined underwriting, avoiding getting too optimistic. He gives massive credit to Ajit Jain for transforming things since 1986 and praises the whole insurance leadership team.
Okay, now the letter takes this kind of interesting, almost quirky turn with the section, what is it with Omaha?
Yeah, this part's fun.
It points out how weirdly common Omaha is for key Berkshire people. Munger, Buffett, Greg Abel, Ajit Jain. Even Berkshire itself moved there in 1970.
It's really intriguing. Buffett tells this great story about his sister, Bertie, again, and how well she did investing after simplifying things in 1980, just using the common sense she picked up growing up in Omaha.
So he asked this open question. Is there something special about Omaha that breeds this kind of success? He playfully throws out ideas like the water or maybe planetary alignments.
It's a charming way to suggest that maybe, environment or shared values can actually shape a mindset that helps with long-term success. He even invites people to Omaha for the meeting and to get the new Poor Charlie's Almanac.
Right. And finally, the letter gives us the big long-term performance numbers, comparing Berkshire's per-share market value change to the S&P 500 with dividends from 1965 all the way through 2023.
And those numbers, they really do tell a story. Over that whole 59-year stretch, Berkshire compounded at 19.8% a year versus 10.2% for the S&P 500. Still great for the S&P, but
Yeah, but the overall gain since 64 for Berkshire is what, 4.4 million%?
Mhm.
Compared to about 31,000% for the S&P 500.
Staggering difference. It just powerfully shows the result of their consistent, value-focused approach over decades.
So there you have it. That's our deep dive, pulling out the key insights from Buffett's 2024 letter. We've covered quite a bit: Munger's lasting influence, the core philosophy, the current challenges and strengths, how the businesses did.
Yeah, we hope this gives you a clearer, maybe more nuanced picture of where Berkshire stands and the principles guiding them. It's worth thinking about, the focus on quality businesses, trustworthy management, financial conservatism, and just plain patience.
Absolutely. Understanding how Berkshire thinks can offer useful perspectives for, well, lots of things, business, or even your own finances, whatever scale you're operating on.
Which brings us to maybe a final thought for you to chew on. Thinking about that Omaha effect and Berkshire's incredible staying power, what maybe less obvious and tangible things like environment, culture, shared values do you think contribute most to long-term success in whatever field you care about?